Please take your seats. So I'm Stefan Durkon. I'm the director here of the Center for the Study of African Economies. And usually, even though the conference has already been going and there's quite a lot of buzz, but this is our first panel, our first plenary. So it's a good moment to briefly welcome you here at our conference. We had, again, more than 800 people that submitted their papers to the conference. We have more than 540 people registered for the conference. Relatively speaking, the combination of Trump visa policies and Heathrow fires have limited the amounts of people that don't turn up, but disruption there definitely wasn't for those who had complicated travel. Of course, you will also have noticed that we'll still end up here in a little bit of a building site. This is a continuing problem at the college here where they have some structural issues with the main lecture theatre and the dining hall. So by next year, that should all be okay. So there's a good reason to come back to see the full glory of the college. But otherwise, I would simply say, just welcome here at the conference. And it gives me pleasure to let Mohamed introduce this particular session. But I want to actually simply say, to make it clear in practical terms, we're going to have first this session here, a panel around entrepreneurship in Africa. That will last until about 6 o'clock. And then actually we have another session before we have food that will be about using tax data in Africa. That we will start. We will give you a moment if you really desperately need to get out, but there will be a 45-minute session that will be talking about administrative tax data and all the kind of opportunities for research that there are. So people that are interested in working more with this kind of data, they would be very welcome to attend. So, but if you don't want to attend that session, please don't walk out at that moment. The session will definitely end at 6:45, well in time for dinner and a more joyful interaction. So with that, I'm just very happy to pass on to Mohamed Mekki. Thank you very much.
Okay, thank you, Stefan. So I think we're delighted here to have our panelists, and I think every chairperson has always said that they're delighted to have their panelists. But as Stefan alluded to on Friday, I received a message saying that there's a fire in Heathrow. What's happening with your panelists? And I was briefly faced with the horrifying prospect of being the only person on this panel, which would have been the most boring panel you've ever heard at the CSAE. But luckily, we're all here. Most of us seem to be here. And unfortunately, Tommaso doesn't get to experience London Luton Airport, but maybe on your next trip. And so this panel really focuses on entrepreneurship in Africa, as Stefan said. We often hear about the exciting changes that are happening in Africa, young, growing population, educated, tech-savvy, all the ingredients are there for growth. And so here we're going to be thinking about how that manifests itself in terms of the entrepreneurial ecosystem, startups. And in particular, what kind of investors are going to finance those high-growth startups and who's going to capture that growth. And so as a field, we know a lot in development about micro-enterprises and small firms. And in particular in CSAE, many researchers over the years have been at the forefront of thinking about micro-enterprises, capital, microfinance, but we know much less about firms that actually hire a larger number of people, high-growth firms and startups. We have much less rigorous evidence on that. And so one of the amazing things that Tommaso and his colleagues at the IFC in Chicago have done is that they've constructed this really interesting data set, and we look forward to his presentation where he's going to give us some very interesting, broad statistics about the entrepreneurial ecosystem. So just to briefly introduce Tommaso and the rest of the panel, Tommaso Porzio is an associate professor in the economics division at Columbia Business School. He's a macro development economist and one of the most exciting macro development economists, the new generation, if I may say so, to embarrass him a little. And his research focuses on understanding fundamental causes of cross-country income differences and designing policies to address them. And then to the left of Tommaso, Alex Fraser is CEO of Viridian, an impact agency that designs and delivers programs, research, and strategic initiatives for early-stage entrepreneurs, investors, and entrepreneurial organizations across Africa's ecosystem. When I first met Alex in South Africa, they have a very interesting initiative, the African Angel Academy, where they train new business angel investors. So it's our pleasure to have Alex here. And then to the left of Alex, we have Rosa Omugui, who's the founder and managing general partner of Echo VC Partners, a seed and early stage technology venture capital firm investing in underrepresented founders and underserved emerging markets. And I first met Rosa at a workshop on finance and development in South Africa, which was organized actually by Emmanuel Colonelli, Tommaso's co-author on this project, and Emily Brazer. And previously, Agosta spent nearly 10 years at Intel, where his role was Intel Capital Director. So very happy to have him. And then to the left, we have Fadilah Tchoumba, CEO of the African Business Angel Network, ABAN. Fadilah serves as fund manager also for Catalytic Africa, a co-investment facility for early stage startups in Africa. She also serves as the director of the African Business Angel Vehicle, which focuses on sector-specific ventures. So before joining ABAN, Fadilah managed investment portfolios for institutional investors with interests in African trade and served as Director of Business and Innovation for the Royal Commonwealth Society. So that's enough from me. I now turn you over to Tommaso, who's going to be speaking for 20 minutes. And the format is going to be this as a framing piece for the panel, and then 10 minutes opening response from each of our esteemed panelists, and then we'll open it up for discussions.
All right, thank you so much for the introduction. Thank you for having us here. It's very exciting to talk about startups in Africa and to do so with esteemed panelists that are actually practitioners in the field. So I really like this idea of bridging together academics and practitioners. So this is an overview of a project co-authored with Emanuele, Chicago Boot, Marcel Marianne, the IFC, and Chun, who is a PhD student at Stanford. And let's see if, yes, perfect. So why do we study startups in Africa? I'll give you just a little bit of a motivation, but the main idea is just that there's a thriving startup scene in many African countries, and we don't know much about it. So that is literally why, we started essentially this project. Just to give you some numbers, like in 2021, collectively, the startups in Africa raised approximately $6 billion with a very fast growth in the last few years. If you look at Y Combinator, one of the biggest, most prestigious accelerator in the US, in the class of 2022, there were 31 startups from Africa. That, if you compare it, for example, from those from Europe, roughly almost half as many as those from the overall continental Europe. If you care about numbers, you may be interested in the number of unicorns. There are 9 unicorns to this day in Africa. Some of them are very famous, like Andela, Flutterwave, or Chipper. So we believe that the sector overall has a large, has a potential for very large impact. Clearly not in terms of employment, right? So this is still a small sector, doesn't employ a lot of people, is unlikely that they will employ a lot of people in the next few years. However, it is a sector that can drive innovation. We know that's also true in the United States, where essentially the startup scene doesn't employ a large chunk of the population, but is responsible for a large share of the overall patents. And not only is a driver of innovation and technology adoption, but also the products that are developed in these companies can have a transformational impact. Just to give you an example, Flutterwave is developing essentially a digital payments infrastructure, which is then used by a lot of small, medium, and even large companies within Africa. So the startups develop products which enable economic growth on the continent. As I already said, we started this project maybe not with a specific research question in mind, but really because we realized there was a knowledge gap in academia. That most of the work in development has been focused on micro enterprises, to some extent correctly so, because most of the enterprises in the continent are micro as of today. But we believe that it's important to look forward and so try to think to study this new sector. Okay, now just another reason why I think today is particularly important to have this conversation is because the sector is facing headwinds. So what I'm showing you in this figure is the number of new firms, and in blue you see the overall Africa continent. Then let's see if this works. Yes, in blue there is overall African continents. Then we compare it with emerging market in pink and developed markets in green. And up to 2022 there was exponential growth every year. More new firms. From 22 to 24, essentially there has been a collapse. Okay, in 24 there are just half as many new firms as in 2022. Okay, so it's kind of a good day today, I think, to ask what drives this collapse, and also what is going to happen in the future, in the next few years. Is the kind of bubble over, or is this just a temporary setback? So what we do in this project, we mainly focus on one aspect of startups, how they are financed. And we're really going to do three things. We develop a new data infrastructure. I'll describe it in a second. We then document one key new fact, that is that startups rely heavily on foreign capital. Again, this is definitely not a surprise for the three of you, but I think it was more of a surprise for us, as academics. And then we ask, okay, given this fact, what are the implications of it? And also what are the drivers, okay, of this foreign reliance? Let me not preview the results because I just have other 15 more minutes. I'm just going to jump right deep into, what we actually do in the project. So building the data. We put together essentially two sources of data, okay? The first one, leverage the fact that these companies tend to be tech companies. So they have very strong online presence. As a result, essentially, we can gather information, both the startups and the founders. How? Well, startups, we can find information through PitchBook and other similar, more specialized data set that cover deals in Southern Africa, especially. So what PitchBook does, they cover essentially all the VC, venture capital, and private equity deals in the global capital market. So it also allows us to compare, Africa as a continent with other areas of the world. And of course, this tells us something about capital flows, but not much about the identity of startuppers. We can then merge that data with LinkedIn, and through Revelio Lab, we essentially have access to the universe of individuals and companies on LinkedIn. We do this merge, and LinkedIn is useful because it allows us essentially to study the CVs of individuals, to understand where they were before starting the company, so on and so forth. Now, these companies tend to be already established. We then do our own survey in partnership with the IFC, which is the investment arm of the World Bank, to essentially study startups at the beginning, at their nascent stage. And we disseminate the survey through the network of the IFC, and we find something around 8,000 startups in 47 countries out of 54. Okay, so in most of the countries. And in this survey, not only we can capture companies that haven't been financed yet, but also we can essentially do an audit study. I'll describe it in more details, but the idea is to try to understand what startups need, to then try to infer from that what are the key constraints for the sector as a whole. Just to give you a sense of the distribution of where economic activity is, this of course is the continent. These are the companies in the PitchBook Plus. And so you can see that a lot of them are in Nairobi, in Lagos, Johannesburg, and Cape Town, and Cairo. So there are clearly certain hubs essentially of startup activity. However, there are companies spread around everywhere. Okay, Kampala is another nice emerging area. Here on the right, these are our survey. You can see, of course, there is a lot of overlap because, unsurprisingly, where there are successful companies, there are also smaller companies that are currently emerging. So, first key fact, capital flows from abroad. Now, what I show you in this figure is on the y-axis, there is the share of all the capital that is financed from outside of the region. So the blue line is Africa. You can see that from the 2010 to today, essentially, this line, there's some variation, but broadly, it oscillates around 80%. Means that for a typical startup, 80% of the capital is coming in from foreign countries, okay, rather than from other countries in the continent. This is something unique to Africa if you compare it to other emerging countries or developed markets where instead there are more around 20 to 30, 40%. Okay. So this is the kind of the key fact. Then you can dig a little bit deeper to try to understand, okay, from which countries exactly do they receive financing. So here we open it up and we see that, for example, this is Africa to Africa, it's just 20% of the flows. The majority of capital comes from North America, which is really United States. We just didn't want to give too much prominence to the US, and Europe. Okay, so just to have some symmetry, I guess. But so like North America and Europe clearly, provides the largest share of funds. DFIs, development finance institutions, are also quite important. China, very tiny. I was surprised. Of course, there is a lot of capital that flows from China into the continent, but not to companies, okay? More directed to government or infrastructure development. You can then, unpack this by region. For example, the capital gets into East Africa. And what you can see is that there's some heterogeneity, more capital from North America to West Africa, more from Europe to East Africa. I'll tell you more in a second why. Also, what I want you to focus on is that there is very little financial integration. So the little capital that originates from East Africa goes to East Africa. The one from North Africa goes to North Africa. The one from West Africa goes to West Africa, okay? So a lot of integration with the rest of the world, a lot of capital coming in from the US, Europe, very little within continent integration. For the one of you that are more into finance, you may ask whether there is a difference between LP or GPs, so limited or general partners. Long story short, the one key difference is that the DFIs show up more as a limited partners, meaning DFIs, are in investors for a larger share of the deals, but sometimes those deals are mediated by GPs, especially in North America. Last, you can ask, okay, what determines this kind of cross-country, patterns of financing? An obvious thing to look at, it is try to see whether, the history matters to some extent. And the answer it is definitely yes. So if you focus here on this quadrant, what this regression shows, it is that past colonial linkages and common language, there is a lot of overlap, still shape today capital flows. To be practical and pragmatic, Portugal mainly investors from Portugal mainly invest in Mozambique and Angola, okay? And these a very strong regularity and those magnitudes are large. Okay, so we have this fact that is that most of the capital comes from abroad. We then ask what are the implications of it. Another way to say it is, should we care about this fact or not? The first thing that we want to highlight, it is that these essentially lead the continent to be exposed to foreign shocks, okay? And so how do we do that? Well, we use the standard shift-share design, which allows us to create a causal link from changes in the foreign supply of capital to local startup activity in Africa. So again, I don't have time to go into the details of the regression. Let me just highlight coefficients and interpret them. So what we find, it is that there is definitely strong evidence of this Bartek instrument working. So what does that mean? It means that, think again about Portugal, when there is some reason why, some shock to the willingness of investors in Portugal to invest more, that is going to affect the entrepreneurship activity in Mozambique, okay? And, once you have this relationship in mind, then it is not maybe such a big surprise, this big, collapse in startup activity from 2022 to 2024. A lot of that can be essentially driven just by the high interest rate set by the ECB and by the Federal Reserve. So the idea is that if capital becomes expensive in the West, then you're going to have less startup activity within the continent. Then second, essentially, we are going to try to make the point that this reliance on foreign capital also guides the reliance on foreign human capital. And so how do we make this point? Well, first, we're going to show you that a lot of founders actually either are foreigners themselves or had some sort of foreign experience. So they studied abroad or they worked abroad. We're then going to use again the shift-share design to show you that shocks to supply of capital in foreign countries tend to affect more the activity within Africa of foreign startuppers. And then last, we show that capital and human capital really flow together. So if you are a founder from the United States, very, very likely you're also going to get funds from the United States. So let me show you these three ideas into regressions and tables just to show you, we actually have the data to back out the claim. So first, this is, using LinkedIn, we essentially can see the characteristics of the founders of the startups. And so let me highlight a few numbers. First, if you look at the continent, more than half of them spend some time either in education or working abroad. Okay. And a lot of that tends to be master degrees. So a lot of the typical, timeline, it is that someone study maybe in their bachelor within the continent, then go abroad, then like founders go abroad for a few years, maybe to get a master, to work, then they come back and they create a company. The other stuff which is striking here is that 44% are like, white. Now, in LinkedIn, you do not know where people are born. And so then one way to try to get a sense of whether, these are actually people that from the continent go abroad or come back, or whether they are foreigners, it is to just look at the color of their skins. And 44% of them from the pictures in LinkedIn, they are white. Of course, not all of them are going to be born outside of the continent, but I think it's still like a striking number. This is Bartik regression. Again, not time to go into details. What I want you to focus on here, it is that shocks to foreign capital affects startup activity of foreigners. Okay, so here are where the stars are. What does it mean? It means that when there is that willingness of Portuguese investors to invest more, what do you see? You see that there is more startup activity in Mozambique, but not of people from Mozambique, but of people from Portugal. Okay, so really it seems that capital guides human capital. And then last, this is a dyadic regression, but just, let me just explain what this coefficient mean. The idea is that if you look at all the investors within the same country, so all the investors, let's say in Uganda, all the founders in the same country, so all the founders in Uganda, those that studied in the United States are way more likely to actually receive financing from the United States, okay? And so again, this tells us that human and physical capital kind of move together. Is like, evidence essentially of frictions such that only founders from a given capital really manage to get access to, from a given country, really manage to get access to capital from that country. Okay. Now, third implication is what we call foreign captures, okay? So the idea here it is that, of course, if you have a lot of foreigners that own African startups, then a lot of the returns are going to go outside of the continent. One way to also see this, of course, this is implied directly just from the fact I show you already, but another way to see it is to look at the headquarters. And so you actually see in this figure that of the companies that are financed with their headquarters being in Africa, a relatively large share of them move the headquarters later on, either to Europe or to the US. Flutterwave is an example. It started in Lagos, but now the headquarters is in the United States. And so this seems to be like a regularity. And of course, those companies that move their headquarters tend to be the more successful one. So again, this idea of capture essentially of the companies by foreigners. Last, foreign products. So what we show here, it is essentially that flows of capital also guides and drives the type of products and business models that these companies develop. Okay. Now, this doesn't have to be bad. Okay. It just may be that it's driven by competitive advantage, but also it may lead to misallocation of innovation. Maybe companies are not developing the type of products which are, most suited for the market where they operate, but they develop the type of products which are similar to those essentially their investors developed or that their investors want them to develop. One way to see this in a regression, it is to look at companies that have investors from the same country and show that they tend to be very similar. How do we define similarity? We can use LinkedIn data and look essentially at the description of a company to try to, identify, the textual similarities of two companies. So just wrapping up this part of the paper, essentially, the idea is we show you this fact, foreign capital, and then we have 4 implications. First, exposure to foreign shocks. Second, foreign capital guides foreign human capital. Third is foreign captures of African return. And fourth, foreign products. Now, in the last, few minutes, let me discuss a little bit, why? Why do we have all this foreign capital? What are the drivers of it? And really, we can consider 2 hypotheses. The first one, it is, well, maybe because startups in Africa search for type of capital which is not available locally. Or second, because they search for type of investors that are not available locally. And we can use our, unique survey to try to unpack the 2 explanations. Just to, preview the results, the data is more consistent with the foreign capital than with the foreign investors explanation. Okay. Why? Because companies are capital constrained, not human capital constrained, and because they show strong preference for equity capital, and that there is not much equity capital within the continent. So let me show you this again in a couple of figures. So here we just ask companies, how much capital do you need? And essentially, the median company asks for $500,000. So these companies definitely do not want microcredit. They want large amount of credit. Do they manage to get it? Well, not really. Most companies get essentially a small fraction of the capital that they seek. In fact, when we ask them what is the main constraint, they say access to finance. And look, this is remarkable. Even big companies, so these are companies extremely successful, still 80% of them say that access to finance is the main constraint. And, it's not surprising if you look at how they are financed, because essentially, small companies, they're mainly financed by personal savings. But even big one, only 30% of them receive any VC or angel money. And in fact, even among the big companies, 1 out of 5 mainly relies on personal savings. Now, last, the survey experiment. So what do we do? Essentially, to all the startuppers, we show them a bunch of profiles of potential investors. And these investors are realistic but artificial, so we create them. And then we vary some characteristics, such as the type of financing that they offer. This is equity, this is debt. Or where the fund is. This is a fund that has headquarters in New York, and this one a fund that has headquarters in Burkina Faso. And then we ask the founders to rank these different investors, okay, and give us a grade essentially. Then we can see which characteristics of the profiles lead to high preference. What's the result? Well, essentially, these characteristics at the top are all the characteristics of the deal. So what do founders want? Equity offers. Strong preference for equity offers. What do they want? Low interest rate. What do they don't care much about is whether the team is foreigner or not. So essentially, this is the idea that if you ask startuppers, they just want equity financing. But equity financing is not really available within the continent, and so then they have to rely on foreigners. It's not that there is a premium just for a foreign team. So it's not that these companies need that expertise, need that consulting that comes with foreign team, or at least doesn't seem from this evidence. Okay, let me conclude. So, and in conclusion, I'm also going to ask some questions for the panel, I guess. So first, we believe that there is a very large potential for startups in Africa. Again, the sector was booming until 2022, is now collapsing. There is an obvious question that is, what is the future of the ecosystem? Now, in this project, we essentially try to do a tiny little step in the direction of understanding the startup ecosystem by essentially building up data. We believe that we're just scratching the surface of what can be done. So, hopefully many people in this room will do more work on startups in Africa. We learned a few insights so far. This key new fact, relying on some foreign capital. A few implications. So this idea that, if you rely on foreign capital, you're going to be exposed to foreign shock. You're going to be exposed, and gather a lot of foreign talent. You're going to be, at risk of returns captured by foreigners. And you're going to be mainly essentially pushing and selling foreign products. And then for us, it seems that the evidence is most consistent with the idea that the driver of this foreign reliance is just that startups need equity finance, which lacks locally. And so then my, key last question is, should Africa develop a local equity market? And, will it happen? Is it happening? Actually, it is happening to some extent. We have evidence in the panel. And then is there any role for policy making and for academic and practitioner to try to encourage this development of the equity market in Africa? Thank you so much.
Just going to give people a chance to grab seats. There are a few more seats in the front if anyone wants to come forward. So first of all, thank you so much, Mohammed and University of Oxford, for inviting us to this panel. And then second of all, thank you so much, Tommaso, to you and your team and the IFC for doing this research. I think that any research that we can do on startups and the African entrepreneurial ecosystem is really important, as we have been bemoaning the fact that there's not that much data for many years, but we are slowly trying to rectify this problem with initiatives such as Proparco's annual report, Africa the Big Deal, Brighter Bridges, the ABAN annual angel investment survey that we do, but we're only just scratching the surface. So I really think that, first of all, the total amount of early stage capital that goes into Africa is small. It is equivalent to the size of capital that effectively is invested into startups that are resident in Miami. And Miami is not a big startup city. That's the whole continent. However, it has grown significantly since when I started in the venture capital industry, which was many, many years ago, and when I did my thesis. When I did my thesis on the South African venture capital industry in 2008, I had to interview every single person 2 or 3 times and redo my findings because there just weren't enough people. I literally interviewed everyone. And when you see the progression over the last 15, 20 years, it has been significant. So while we have seen investment levels drop since 2022, they still are at pre-COVID levels. And what is really interesting is that we're starting to see debt and other innovative financing mechanisms and angel investors start to play a much more significant role in financing the ecosystem as a whole. I think what's really important is that the entrepreneurial ecosystem in Africa is broad. It is not just startups and micro entrepreneurs. I think it's very nuanced, and I think there's still a bit of a problem where many people almost self-identify as startup founders when they typically wouldn't actually fit a definition. And certainly not every startup is necessarily VC fundable. So that's something that we need to look at. We also know that a lot of investment data is also underreported, not really collected. Data is still incredibly expensive and time-consuming to gather. We employ a full-time research and data analysis and almost introduce Elze at the very beginnings of our programs to say, you will hear from Elze that you're coming on this program. Please do trust her. She is part of our team. Please give her sensitive information. So it's still very trust and relationship based. And I still to this day sometimes get emails from angels who participated on our programs, don't want to give us financial data through a website form or Cognito form, but rather will email or WhatsApp me deal data confidentially myself. So that's just some of the kind of nuances that we need to kind of think about. I do think that there are still strong ties colonially. If you look at the DFIs and where DFI is prioritizing their involvement, if you look at something like the UK International Tech Hub, which has done a lot of work, which countries do they invest into? Nigeria, Kenya, South Africa. Where do African entrepreneur or potential entrepreneurs or students get access to bursaries and scholarships to go and study abroad? Often it's, if you're based in South Africa, one of the easiest places to get a scholarship is actually the UK, where you've got the Chevening and the Commonwealth Scholarship. So I still think that there are those linkages, and it's not just necessarily influencing just the startup flow, but I think it influences a broader ecosystem as well. There's also been a lot of talk recently around, is Africa too reliant on DFIs and DFI funding, especially with the collapse of USAID? And we certainly know that there have been a number of startups and startup programs as well that have been impacted by that. And I would say that while DFI funding is really critical and important for various sectors and projects, I think it's a little bit of a red herring, because I think we need to almost take a broader picture, in that there's a lot more capital coming into the continent than just DFI funding. If we look at the recent report by BII on DFI funding coming into Africa, they tracked it since 2010 and it was $78 billion. Whereas you look at the volume of remittance in terms of coming into Africa, it's close to $100 billion per annum. So huge amounts of remittance that is transferred back into Africa. And many of this is to support various initiatives and startups and angel deals, but it's not often counted. And also with this call for Africa to be more take ownership in terms of investing more in our own startup economies. I think there's still a big behavioral change. Only very few countries have legislation requiring or allowing pension funds to actually invest in high risk asset classes, such as local funds. But ultimately, we also need employment. We need to grow our tax base, and we need to grow people into formal employment who then pay pensions, who then are able to also grow that pool of local capital. What is interesting as well, it was fascinating to see where the capital was flowing, but there are a lot of the older venture capital funds on the continent, and I'm sure Igosa will speak to this as well, that many of the entrepreneurial or many of the venture capital funds are actually have been established by families and family offices, and were traditionally actually started by entrepreneurial families, which then set up funds. So if you just take South Africa as a very small kind of example, but Remgro and Invenfin were essentially funded by the Rupert Foundation, Knife Capital and Hasso Platinum by the Shuttleworths, Yellowwoods, etc. So some of these funds are now tapping into DFI funds, but we're actually seeing that the more established funds were almost happened because of that. What we're also seeing as well is when people are foreign educated, there are these innovation advantages as well. Often when you study internationally, you might be exposed to more activities of the technology transfer offices. There might be more entrepreneurial universities. There might be more impetus to actually allow you to commercialize your research. We're dealing with a wonderful entrepreneur based in Kenya, Carol Ofafa. She developed a piece of charging technology during her master's at Glasgow University, which she is then commercializing in Kenya in the e-mobility space. We also see that angels are playing a huge role. Many of our angels are successful entrepreneurs or play in the venture capital or the early stage financing pipeline. These are often, we've trained over 720 angels in 26 African countries, 54% of them women. They're investing their own wages and kind of current assets, so are professionals and are working actively in sectors, while the economic returns for them are important. We're also seeing that they are also looking at impact returns, and often they will invest a combination of instruments, whether it's a convertible note, debt, or equity. And then my last point is really around the legislation and policy. So I think that is a huge piece of the puzzle. We have exchange control regulations, we have IP movement restrictions, we have currency fluctuations, and if you are going to raise internationally or exit internationally or sell internationally, it is much more advantageous to set up a foreign structure. So what you'll often do, even as an investor, you'll help your entity to actually register offshore. You'll use capital allocation allowances to do offshore and almost look like an offshore structure with an operating entity in country, but it's actually because the legislation and the policy just isn't fit for purpose to even allow for these early stage investments mechanisms. So I think some of that capturing that you see around those foreign entities might be because of policy irregularities and lack of investment incentives. There are no investment incentives in Africa. It does not make sense on paper to be an angel investor. There's no tax incentive. So often you need to use foreign mechanisms in order to even just structure things. And it's also much, much cheaper to do this right at the start than to do it once your startup is established and a little bit further down the line. And I'm going to stop because I'm out of time. Otherwise, I could speak for a long time and hand over to Igosa.
So thanks a lot. That was fantastic. I'm glad I didn't go first. But I'll hide in the middle. So my name is Agosa, and I do early stage investing in Africa. I used to be at Intel Capital in Silicon Valley. So I'm one of those that started off in Nigeria and then relocated to the US and left Intel Capital in 2010 explicitly to sort of set up my own path. I was actually the one that sourced Facebook for Intel Capital. We never did that. Left $80 billion on the table. And I was like, look, I got to go to Africa and do something real. And so it's been 10 years, right, since we've been operating as a venture capital firm in Africa. And a few observations. Fantastic paper. I read it twice. It's 96 pages, just so you know. And the slides were 148. So I did read this. So a few observations about sort of what we've seen over a decade. And it's enough time to be able to get some insights because a typical fund life timeline is 10 years when you're supposed to actually return the fund and close it down. But, everything's going to 15 now. So a few things. One is that when we first started, the original plan for my firm was to take the Silicon Valley style of investing, which is taking high risk investing at the earlier stages, pre-seed or seed or whatever they call it today, and cross-pollinate the two most interesting underserved markets that we recognize. Those two markets were Southeast Asia and Sub-Saharan Africa. And the thesis was that they were much more positively correlated than most people realized. And when I went out to raise money, which was primarily in the US, they were like, so why are you wasting your time? Sit in Palo Alto and make money. These markets are never going to amount to anything. That turned out to not be true. But what we then started, we were able to raise some money, interestingly enough, from the US and also locally in Nigeria. And, we've learned a few things. One was we're the first investment firm to be chosen by the government of Nigeria to run a fund that was focused on ICT. The government defaulted. And in part, and I'm very candid, in part because we were not willing to engage, in quotes. And so we're like, look, I'm American, I don't do that. And so we then sort of started off with sort of a subscale sort of vehicle. And so now, 10 years later, here are a few things that we sort of discovered. One is that Tommaso is right. The dip from 2022 to 2024 was a much broader scale dip. And we always sort of said this, that the day this ecosystem collapses on itself, broadly, Africa, once the US catches a cold, Africa gets pneumonia. Right? We knew that. And we knew it because it has happened before. We see a lot of people who forget that venture is a sort of a cycles business. You're not learning anything new. You're there 8, 10 years, you've seen a bunch of things. But there were a lot of people in the market that didn't have a lot of the reps and experience. So that was a problem. The second was that he's absolutely right about capital guiding decisions. So we manage a pool of money for a US private equity fund doing venture. And it took me a few years to understand why. I think we brought 21 deals, fully packaged, and they declined all but 4. And then I realized that the 4 that they did not decline all had these foreign-based founders. There's a specific look and feel. They went to Stanford, they went to MIT, they went to Columbia. Shout out to Columbia, right? But the ones that we couldn't get approved were local founders. And when I look back now, I look at those local founders and they absolutely killed it, just delivered. But they were never good enough on paper. Interesting. Another interesting point is we run what we call pods. So we do different types of investing into different sectors. We realized that it was much easier to actually raise money when you had sort of vertical focus. So we have a climate fund that we've just deployed. And we're surprised as part of the research into the basis for raising a fund like that to find that 92% of money coming to climate startups going to non-African led companies. 9-2. Which is just crazy. So we went out and raised a fund to invest only in African-led founders. People were like, it's not possible. 14 companies later, they're like, holy smokes, they exist. And we said, yes, they do. And they're doing really, really well. All but one is profitable. Which leads me to another thing, another sort of interesting sort of impact on the dip in 2022 dip. We're seeing more founders now who are not interested in getting on the venture capital flywheel. For whatever reason. Maybe they see a lot of people who failed, a lot of people who never sort of were in the business of creating 10-year, 20-year, 30-year companies. So a lot of them are less interested in venture and are designing companies the way you expected them to be designed. So companies that literally get funded by customer money. Imagine that, right? Revenues, product market fit. Now you talk about fit and then you run into another problem, the DFIs. So when we started, DFIs were like, VC, what is this thing? This is kids table stuff. We're doing private equity. Then a few years later, they're like, whoa, this VC thing can be big. So let's go invest in it. But you know what? Our best idea is to do first-time managers. So 5 years later, they're like, there's no liquidity. What's going on? Not understanding for some bizarre reason where they wanted to run an experiment. I don't know what it was. Maybe it was an experiment, could have been, about investing in first-time managers, right? So I'm like, oh, you're running experiments. Great. So they come to me and they're like, hey, also, we hear you're raising another fund, another climate fund. I'm like, yeah. They're like, boy, the companies you invested in this first one are super interesting. Would you take the FI money? And I said, I don't know. And they asked why. And I said, well, you would never have given me permission to do this. The pilot fund I raised to showcase what was possible if you were looking for African-led climate companies, you would never have given me permission. Because a lot of the funds you see funded by DFIs are products designed for DFIs, less so for the market. Which brings us to another point. What should products designed for this market look like? Well, they should look like a grocery store. They should look like an aisle in the grocery store. They should look like a series of SKUs where you essentially sit down and say, today, I picked this one up. Tomorrow, depending on the stage of advancement of the company, I take that one back in, I pick something else. So really what our responsibility is as investors is to think about building a portfolio of financing products. But you can't get that across. The point is just not, because they're like, well, about 2 and 20, which for you is just sort of essentially the economics of funds, 2% management fee and 20% carry. And we're like, that's not fit for purpose. It's not fit for market. So you now have that sort of interesting cycle where we're unable to break out of it because it's the problem. Now, Tommaso also points out something I thought was interesting, which is when you looked at a lot of the founders, they were much more interested in equity. True, but it's nuanced. One of the things that American and European investors did was they changed the narrative around valuations. Because a lot of them come in and they're like, oh, this is going to be $1 billion business. Because when you're sitting in Palo Alto, everything looks like $1 billion business, right? I lived in Palo Alto. Then I lived in Lagos. And Lagos was what taught me what coefficient of drag meant. I always thought it was just things to do with like how you bring cars to market. But no. That's the concept of coefficient of drag, which is literally when you're going out to a market, in these markets, both visible and invisible drag. To become $1 billion business is really, 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 really hard in these markets. Forget what the valuations say. So Tommaso has a list of companies that are unicorns. And I can tell you today, none of them is. Not a single one of them, right? So what you're seeing is the change in business and the change in markets really sort of requires a different type of entrepreneur. One that's more resilient, one that figures out how to sort of serve the market. And more importantly than everything else, is able to design a product that works for the market. We've always had this concept, that's my finishing thought, that in emerging markets, and particularly in Africa, it is your responsibility as an entrepreneur or founder to build zero cognitive load products. Products that when someone wakes up in the morning, where their first thought is there's no power. then there's no water. Then there's going to be traffic and the fuel has gone up 5x. Your product cannot add to that person's sort of burden. And a lot of that is what I think is designed for retention, for people to make your product a habit. So for what we've seen, we like the directionality. It's tough, but we keep doing what we can. Thank you.
I couldn't agree more with Egosi and Alex's stand. First, I would like to thank the University of Oxford for extending this invitation. And of course, I would like to thank you also, Professor Tommaso, for and you and your colleague for the research that you have done. So just to build on what Alexis and Egosi has mentioned earlier on, I would like to focus on local capital participation. And I think that portion has been overlooked for a very, very long time. So today I pretty much manage the African Business Angel Network. Today, which is a community of about 75 angel network across 37 African countries. And with the participation of over 5,000 angel investors. And these investors together have committed capital in 408 deals that will account for about $22.5 million. Now, the first fact that I want to establish is this. The angel investors on the continent are the one that created the foundation under which a lot of VCs, whether local or foreign, and DFIs are actually riding on today. What does that mean? It's because of the angel investors that we have on the continent that we today have a pool of investable companies for the VCs. And the DFIs only came in to amplify what already existed. And when you look at angel investors or the so-called unicorn, I know Egosi would not agree. I would rather call them multi-million-dollar businesses, right? That are doing very well. When you look at those multi-million-dollar businesses, you look at the cap table, you look at the initial investors, every single one of them will have a business angel. Now, if you found out about one that doesn't, I would really be happy to know and find out why an African investor didn't commit capital in the first place. When you look at the ecosystem to date, you will see a large fragmentation. And you will notice that data that are being captured today really concentrated around the 4 countries that we know: Egypt, South Africa, Kenya, and Nigeria. And there's a reason for it. Why are these countries so advanced? I will even put it this way. Why do they have a more mature capability and maturity framework? Perhaps that's a research question. So when I discuss with my elders in market, they say that, well, Nigeria had a lot of a huge contribution from Google about 15 years ago. And that created an ecosystem that became a lot more dynamic. Also built capabilities, and other elements that made that specific market as dynamic as possible. So, moving on to policy. Why are African contribution or participation into the startup scene not captured? Data. It has been extremely hard to collect data. Even though we started about 5 years ago to create annual reports, I can admit to you that we're yet to capture the entirety of the whole continent. But that does not mean that Africans, local business investors are not participating, right? And moving forward, I know that with the many research projects that are emerging, we'll be able to have a clear picture. But now, when it comes to policies, can Africa accelerate the participation of local business angels? Yes, Africa can. There are many aspects of the policy that we have pretty much discussed on the continent that we believe will be able to drive the participation of local capital. These include tax incentive that was mentioned by Alex earlier on. How do we de-risk business angels' participation? We do also have guarantee funds. How do we make those business angels more comfortable in participating in high-risk companies? Because that's what it is. But nevertheless, we have seen a kind of a growth interest among the policymakers in finding solutions that will really help and accelerate local capital participation. So from a business angel perspective, we know today we are at around $22.5 million, and by 2027, we want to reach $80 million deployed on a yearly basis. That will require the participation of approximately 5,000 plus angel investors that are very consistent and professional in their way of pretty much investing in these early stage companies. And of course, there are many actions that we have taken in order to drive those, such as creating funds. We launched the first matching fund on the continent called Catalytic Africa. So Catalytic Africa is essentially a matching fund that we have built to co-invest with our local business angels. And we piloted the fund with $1.5 million. And with the $1.5 million, we were able to unlock approximately $3 million from African Business Angel Network. So this is a proof that when we have a framework, when there's a framework, when the framework is clear enough, Africans do actually participate. The other element that we have looked at is around the guarantee fund. How do we continue to de-risk the participation of local angels in making sure that they can continue building the pipeline that is much needed for the commercial funder like the VCs and other funders like DFIs. So essentially, our role is to continuing, first of all, recognizing that on the continent, there are tech startups that are being built. There are tech-enabled startups, such as SMEs, that are also being built. But also understanding that business angels are also moving from sector agnostic to sector specifics. And these sector specifics are very much deliberate, designed to drive economic development in key sectors on the continent, which include agriculture, energy, smart cities, sports and culture, and many other sectors that we believe are the key drivers of economic development. So thank you.
Okay, thank you to all the panelists. Now I have to earn my dinner and choose between the hands for questions. So we have about half an hour remaining for questions. Let's start, okay, at the back, blue jumper and then blue jumper in front.
Okay, hi. My question is for Tommaso. In your presentation, you talked about the trend line where we saw deployment in 2022. My question would be, in your paper, do you have more like the causes of this plummet? And if you do, is it possible also to come up with more or less a policy document that could be presented to the African continent and showing ways that this dip can be curtailed and also leading to probably sustainable growth in the nearest future, basically.
I'm going to collect a few questions. So the blue jumper in front as well.
So my question is to Fadilah, sorry, I hope I didn't butcher your name. In terms of de-risking angel investment in the region, I think it's a great idea, but I would like to pick your brain on one point. How different would this be from the numerous tax breaks that governments have been asked and encouraged to offer to FDI that seem not to have worked? And I mean, others claim that it's actually led to a lot of fiscal costs to these countries. So when you think about the de-risking, are you referring to financial incentives or it's more on regulation and other things?
Dennis?
Thank you. So the question that touches on, Fadilah, your contributions and also sort of the data sources, Tommaso, that you're using. So I believe the claim that sort of foreign appears everywhere on the human and the physical capital and everything that you showed us. But are you sure that you're capturing sort of all sources of capital, or is your choice to go with LinkedIn and Pitchfork as your primary data sources also maybe telling you a slightly different picture of all the sources of capital that might be there on the continent?
I'll take just one more gentleman next to Dennis, and then we'll do some responses, and then we'll take another round. Beige jacket, yeah.
Thank you very much. My question is to Egosa. Looking at the African VC space and the fact that investments have been plummeting, there's something that I had a discussion with a gentleman in this space on Monday, and his view was the system of investments has to be revamped, i.e., more or less what he called spray and pray and more into targeted investments, apart where there's more significant stake as well as oversight. My question essentially is, what is your take on this? Do you feel, especially given that there's, with the various failures that have happened in the African space, it's starting to look like it's a low trust, starting to look like a low trust game, and then essentially more control will build more trust. What is your take on this?
Okay, so let's do some responses. I think we start with Tommaso. First question was to Tommaso.
Sure. Can you hear me from this microphone?
If you just use Alex's microphone.
Okay, I use this one. Perfect. So thank you so much for the questions. I'll answer both questions, I guess. No?
Please.
Okay.
As many as you want.
Don't do that, because I can just speak for 25 minutes straight, and then, yeah, exactly. It's not a good idea. Okay, so the first one is about the plummet, right? So the collapse from 2022 to 2024. The truth it is that we are now in the process of trying to quantify the contribution of external decline in capital supply to what is happening within Africa. As typical of academics, it's taking us forever to actually come up with a paper. So we don't have it yet. Hopefully we will have it in a few weeks, and we will disseminate broadly. But I can share some preliminary result. And in practice, it seems that it's hard to connect. So what's the story, first of all? The story is that in 2021, there was a very low risk-free return from, within the United States, within Europe, because the interest rates were extremely low. And so then essentially investors were just searching for yield. And so just looking for investment opportunities elsewhere, among which in Sub-Saharan Africa, in Africa more broadly. Now, with an increase in interest rate, of course, now you can just park your money in a bank and get 5% risk-free rate. The desire to invest in riskier activities collapsed. And as Goza put it, this is of course true, also within the United States, but as the US, I guess, catch a flu, Africa gets a pneumonia. So I think that to some extent there is a lot more redirection of capital from Africa to within the United States. But it's literally just connected to the interest rate. Now, can we quantify that? We are doing it. We can use those regression coefficients to quantify it. And, it seems right now that it's probably something around 1/3 at most of the decline within Africa can essentially be linked to the general, decline in desire of searching for risk. So that means that, there is something else going on. And I'm actually curious to hear, from you, whether you think that there is something else going on, why there's just less startup activity in the last couple of years. On the second question, Dennis, and by the way, I should have said, thank you so much, from all, your comments were extremely interesting, especially Agosa that say that, we are right. So, referees in the room, please, remember. But anyway, so back to potential referee Dennis, selection. So the truth it is that I think we're going to be very careful. We are only looking at formal capital. Okay, so we are looking at deals which essentially have some sort of online trace. That's definitely not all the capital. Our work shows that it's not all the capital, because for a typical, small startup that we reach with our second survey, only 20% of capital actually comes from VC. A lot of capital comes from friends and family. And so those are part of the angels that, maybe we are talking about. Some of those essential investment just happen through networks, and we will not see those. So I think we're going to be very, very careful. At the same time, it is important to notice that this formal capital, not the informal one, mainly comes from abroad. Okay, let's stop here.
Okay, I think Fadilah, you had the next question about de-risking.
Right. In terms of taxes, I think that was the question. I would just like to focus on that. And I would like to take an example. So, so far we have, I think, a critical base of angel investors on the continent. But to make this work, we need a critical mass. How do we move from the critical base to the critical mass? Let's assume that you yourself, you're an angel investor. And we know very well that angel investing is one of the riskiest investment in the value chain, right? And you are willing to deploy, let's say on a yearly basis, around $50,000. By year 3, let's say 90% of your investment have actually failed to your understanding of win and losses. And you give up. But the continent actually needs your capital. So how do we encourage you to continue investing? One way we can do this is saying, you know what? You can actually get a tax rebate, 20% of the fair ones, or the capital, or they say 20% of the capital that you have invested. You can recover it to like a tax rebate. Wouldn't that be okay? Oh, nice. Within 5 years, you have about 5 years. And you can even make it sweeter, like we say. You can say, in order for you to claim back that tax, you have to be a registered angel investor or business angel. And you have to be recognized by some certain types of laws. And to get that certification, you have to comply to a number of things. So what we're essentially doing is building a pool of consistent individuals who will be continuously investing their own capital over time without necessarily getting discouraged by unsuccessful businesses that they will have in their own portfolio.
I think Alex had a comment, and then Agosa had a question.
In terms of de-risking, I think there's a policy element there as well, but I think there's also an education element. So especially when it comes to the technicalities around deal structuring, especially understanding your local legal context, due diligence, valuations, sector-specific investment. We've seen that for every single dollar that we've spent in training angel investors, $6 are deployed by those angels into the private market. So by increasing an angel's confidence and their technical skill and ability, we're seeing that level of investment increases because they are able to make better choices and do better deals. versus other angels that go into the market, get burnt, and then stop investing. So that's really critical. And then also looking at match financing is really great, because if you can match finance with an angel investor, they've got a vested interest in really growing that business and to see it succeed. So can you give them additional match funding? So there's a GIZ program called Develop PPP, which matches 100,000 up to 100,000 euros with 100,000 euros of private capital. We're about to launch a program funded by Orange Corners, the Dutch government, called the Orange Corners Innovation Fund. And we are strongly partnering with angel investors, because we're giving up to R1 million in 50% grant and 50% in interest-free unsecured debt, which really takes those businesses up to the next level and kind of bridges that gap between angel and kind of seed or Series A. Or even businesses that don't want to raise equity but need innovative financing mechanisms to grow.
Also, there was a question about trust and failures.
Yeah, on low trust environment. So, what's sort of my observation is that we've always had the opportunity to cross-pollinate knowledge in Africa, but we seem to not want to use it. So even when we first started, we would tell a lot of these investors, this market will be cyclical, and you will think you are really smart right up until the point where it chooses to humble you. And, lots of people were walking around saying, I've got this unicorn and that unicorn and so on and so forth. And, they don't really exist anymore. Right. And so I think the challenge is that you're now finding a lot of different types of triggers for what you're seeing and hearing. One of them is that a lot of these founders, and I think, Tomas, you actually made an interesting point in your research about governance. Right. So we were not the most favored VC firm because I don't play with my money. Right. So when I put my money in, I have expectations. And so what you found was a lot of people were doing spray and pray because everything, is a classic, book, number go up. Right. And so you now find this sort of backdrop where all of a sudden people realize number didn't go up. In fact, number disappeared. Right. So you now have, I've lost all my money. Then you find out that the founder has relocated to Canada with their families. They're sending monthly reports, but the business has not really existed for 2 years. But they're still sending monthly reports. Right. So you now have this sort of, you think it was low trust, it became paranoid trust. Right. And so now all the investors and the VCs are like, maybe we need to do more concentrated portfolios. That's a very different strategy, by the way. You're moving from one type of strategy to another. Right. And then you're also finding that many of them. So I'll confess, there was a point in time 2 years ago where I called a bunch of fund GPs and I said, enough's enough. You're letting these founders get away with murder, and you're not imposing governance because you want to be founder friendly. That doesn't work. You need to sort of figure out how to manage them. And so eventually, there's now a new governance code and housekeeping seal and a bunch of things. 2 years, right? Wasn't trying to get credit for it. Let the younger folks do that and get their credit. But the more interesting thing to me was, can you effect it and make sure that it works for these folks? So changing the strategy about how you invest and how much you invest is not what you need to do. What you need to do is to figure out that the founders you're putting money in have sort of the necessary guardrails to be able to sort of execute. And that's why I keep saying, the one thing we've learned because we invest in different segments, vertical segments, is that the segments that are not popular to invest in, so climate and ag, those are mission-driven founders. They will take $1 of investment and what they will do with that dollar, because they have no idea when the next one is showing up. Meanwhile, the fintech founder is like, I just show you something, and look, Africa is 1 billion people, and they will all be paying. Right.
New offices.
And you're sitting in brand new offices, driving matching G-Wagons. I mean, all rubbish. I haven't driven matching G-Wagon and you are driving it with my money. What are you talking about? Right. So I think what we found is, that dip has really helped because the easy money went away. right? And, and I've been an instructor at a bunch of the African Angel Network, African Angel Academy, and so on and so forth. And you find that the angels are still willing, but they just want to now put not just more discipline, but more knowledge into it, right? So things like diligence, people that never did diligence before. The founder could miss the mirror and talk about fintech and you send him 50K, right? That doesn't happen really anymore. Now, I will point out something that we should watch for. So in my bio, most people don't know, I used to be the lead AI investor at Intel Capital. So I led all the investing activity. And one thing that worries me, and it's a thing that you might see in the dip for financing, is that Africa doesn't have a lot of organic AI activity, right? A lot of the money going into venture now is AI focused. So when you're not doing AI, no one has time for you, right? So, but what I keep saying to people when I'm like, look, I've been an AI investor for over 20 years. What worries me more than anything is what I think is going to be the disproportionately negative impact on the continent with AI. And I don't see a lot of people, investors and founders thinking about that. All they're thinking about is, number go up. Wow. That happened 3 years ago. We'll do it again. All right. So hopefully to answer your question in a somewhat long-winded way, yes,